And for more on the global markets, particularly with the Fed statement today and what that means, we're joined by Anthony Chen, Chief Economist at Chase. Anthony, great to have you back on the show.
Glad to be here.
And let's indeed start with what we can extrapolate from the Fed minutes. Seems like a more hawkish overall tone that monetary policy makers thinking that the economy could improve. What's your take?
I think it was hawkish. I think you hit the nail on the head, but it was hawkish for the right reasons, and that is that the U.S. economy is improving, labor markets are improving. So when the Federal Reserve starts talking about raising rates because the economy is getting better, financial markets love it, and that's the reason why equity markets are rising.
And that's why the market reacted favorably to that.
Absolutely.
So what is the time frame that you think this can happen?
I think that every time the Federal Reserve starts sounding a little bit more hawkish, we probably have to move up the timetable a little bit. I think right now we're looking at something closer to the second quarter of next year instead of the third quarter of next year.
And a very basic 25 basis point increase to begin with.
Remember that when the Federal Reserve moves after such a long period of keeping interest rates at low levels, they're not likely to go at very fast increments. So absolutely, 25 basis points is probably going to be the first move.
A big central bank meeting happening in Jackson Hole, Wyoming, starting on Thursday. What can we expect from that?
I think we're going to continue to hear from different central bank heads as to how their economies are doing. Janet Yellen will have to walk a very strong path, but certainly in a very delicate manner, because she still believes that there's slack in the labor market, even though some people at the Fed don't believe that. Then you have the European Central Bank, which are now experiencing continued declines or disinflation. The inflation rate now running at 0.4% with a target of 2%. So they're probably going to have to do a lot more. Kuroda in Japan is probably going to have to do a lot more because the second quarter was a lot weaker and the recovery is perhaps not as robust as they would like.
All right, let's focus on what we can expect to hear from Mario Draghi and how much correlation is there with what he thinks and what Janet Yellen thinks. How much sort of cooperation is there between the central bank heads?
Well, I think all central banks want their economies to do better. In Europe, we're experiencing a situation where the second quarter was somewhat of a disappointment of economic growth. In the United States, it was actually great news, the economy performing even better than the central bank was expecting. So in that kind of an environment, Mario Draghi is going to have to offer to do a lot more. The targeted literal operations that he's already put on the table, perhaps he has to boost them and make them a little bit bigger. The asset-backed securities that he's talked about, perhaps he has to accelerate the time frame for those. And the quantitative easing, which is the long run, a long shot possibility, perhaps increase that probability just a notch or two.
Anthony, I want to talk a little bit about what the Russian sanctions mean for the EU and how that could play into sort of central bank decisions. We've got the Russia, US, and EU, the sanction standoff. What impact could that have?
Well, I think there's no question that Europe has a much greater dependence on Russia than the United States. Their exports are a lot stronger. The energy dependence is there. So if you're seeing these Russian economic sanctions having a negative impact on European Union countries, guess what the central bank is going to have to do? They're going to have to offset that to some extent, so perhaps be a lot more stimulative.
Can they afford to inject even more stimulus?
Oh, there's no question, because right now, believe it or not, when you look at what the U.S. Federal Reserve has done and you look at what the European Central Bank has done, night and day, the European Central Bank hasn't done as much. So they clearly can do more. And by the way, they have to do more because the economy there is much weaker than it is in the United States.
I want to bring it back to the United States and the NASDAQ, the best performing index so far. Technology stocks doing very well, but Janet Yellen cautioning that we could have over-enthusiasm, overheating in the social media and in the tech sector. Do you agree?
At any given point in time, we can have a little too much exuberance. We can have too much enthusiasm. But right now, when I look at technology, I ask myself, is technology a sector that's going to perform better in the future? And the answer has to be yes. Minimum wage rates are going up in some states. It's a matter of time before minimum wage rates around for the nation start to increase. So guess what companies are going to have to do? They're going to use a lot more technology. Profit margins are already at record highs. They don't want that to go away. So more technology stocks will benefit.
All right, so still long in technology. As always, great to have you on the show. Thank you so much, Anthony Chen, Chief Economist at Chase.